Capital shopping centres' first half underlying earnings per share increased by 14% to 8 pence, while diluted adjusted net asset value per share was flat at 391 pence. Joining us on the line now from London to unpack these numbers is the company's CEO, David Fischel. Thanks so much, David, for joining us this afternoon. So we've seen first half profit rise 53%, boosted by January's purchase, specifically of Manchester's Trafford Centre, but also higher rental income. Just what kind of a market are you pushing those higher rentals onto, where you're looking at just over a 6% increase, but one would imagine a pretty tough environment given that consumer spending in the UK is faltering?
Yes, you're right. I mean, the economic background for the 6-month period was challenging, particularly consumer-related industries. But we're pleased to report what we have termed a sound operating performance. 6% growth in like-for-like net rental income, feeding through to 14% growth in underlying earnings per share. Footfall was up for the period, up 3% for the third consecutive year. Occupancy was high at 97%. So I think what we're seeing in the UK is quite a structural shift going on, where the larger centres, such as those owned by CSC, with a strong catering and leisure component, are just continuing to outperform smaller centres and the high street. And it's particularly important in that is catering and leisure offer. I've seen a lot of restaurant lettings in the 6-month period, and I think retailers generally are focusing their attentions more on these flagship locations.
Let's hone in on that occupancy rate, because you mentioned it coming in at 97%, which means that, relative to the UK average within the retail space, which sits at 11% vacancy, you're looking at pretty strong numbers. But given the poor economic data we've seen filter through globally, are you expecting pressure to mount on that front?
No, I think the measure is a proper reflection of the quality of our assets. We've got 4 of the 6 best out-of-town centres in the UK. Got 10 of the top 25 centres in the UK in our list. So, we're right at the right end of the market, and these centres are still proving very attractive to retailers and to shoppers. So, you're seeing secondary locations really suffering, but the prime locations continuing to do fine. So
just to give us a sense of your pricing power that's currently at play, I mean, how are lease negotiations expected to progress moving forward, and what kind of increase in terms are you anticipating?
Yeah, I mean, we've seen in the 6-month period, we've seen increases in some of our centres. So Lakeside in Thurrock, Manchester, we've seen increases. We've seen increases for restaurant units and generally for the large units, whereas sort of smaller units in the smaller shopping centres have been more difficult.
Yeah. Concern in the investment community has arisen around net asset value, though commentators saying that they see that improvement in NAV needing to happen, and that needs to happen more so via uplifts in property valuations. Have we hit the bottom on that front? What's your outlook moving forward when it comes to property valuations in the UK market?
Yeah, our view is that shopping centre valuations, or for prime shopping centres, are still very defensive. They're well supported, the yield structure, and we've seen over the last 6 months central London assets really performing in valuation terms. But we haven't yet seen that happen to large shopping centres. So I think it's the sort of yields we're now looking at, which is over 6% equivalent yields when interest rates in the UK are 0.5%. It's still very attractive, and there's no doubt there's plenty of international investor interest and demand for these sort of assets.
If a double dip does come to the fore, and certainly we've heard a mention of that phrase yet again over the last couple of trading sessions, what impact do you see that having on NAV?
Well, I mean, the UK economy hasn't really gone anywhere for the last 9 months, and I think our expectation is for a period of continuing sort of relatively weak growth, sort of sub-trend growth. But You know, our job is to keep performing in any economic environment and making sure our assets outperform the market.
So let's look at your strategy within that context, because we had Capital Shopping Centres fend off a bid from Simon Property Group in January. Has your strategy changed at all since then in terms of managing the business?
No, the priority is exactly the same. Where the most fundamental measure for our business is like-for-like net rental income growth, 6% in the first half year, and we want to continue focusing on that number. We've also got a whole range of what we call active management projects and some major extensions in the pipeline as well, and we want to keep moving those projects forward and keep creating value through new investments. So those are the priorities for the business.